Peter Gerard, for you, I'd like to ask you how you think the South African banking system can influence retail property investments.
Well, I don't know if they can, but there are certain banks who understand property a bit better than others. But in the main, we've found that if we go with a sensible new project, the banks will normally follow us. But that didn't always happen. I mean, initially, when we started in 2001 as Flanagan and Gerard, they said, well, hold on, you've now left the Seifrieds and Collier's RMS side and so forth. And we had to persuade them that what we said was correct. And I remember at Lakeside Mall walking the credit committee of a certain bank around the center, and I explained to them what we were going to do, because they initially thought that Lakeside Mall was a dog. Well, not a great center. And I told them what we were going to do, and a year later I took them round again and I showed them the center. I showed them that we had done what we said we were going to do, and I told them what we were going to do over the next year. And after 2 or 3 years, they took our word for it, and they said, fine, you guys obviously know what you're doing. And it made our lives so much easier because the bank understood that we knew what we were talking about. But, the banks, unfortunately, in South Africa over the last few years have backed a number of ventures which were not well conceived, and the banks are now having to buy them back in again, which again opens other opportunities, in that certain investors such as ourselves may be able to buy some of those assets at realistic prices.
It's part of the cycle, isn't it?
Yeah.
What happens, Canal Walk's a prime example of
Canal
recycling of an investment.
Canal Walk was developed initially by Martin Ragg, if I'm not mistaken, and it was oversized at the time, and I think probably still is oversized. I think they've probably got tens of thousands of square meters behind the shop front which have never been used. But the thing went, I'm not sure if it actually went belly up, but it didn't succeed, and then was bought by new property investors who actually, they did know what they were doing, but only just, and it's now a very successful center.
Yeah, I'd like to make another comment on the banking side. We spoke earlier about the need for recognition we're dealing with a long-term asset. And when you look at the development sector, as opposed to the investment sector, a lot of developers, and I suppose we started in that way, would create a product and try and realize it by selling it into an institution so that you could take some margin on it. In other words, go in at cost and sell it at value. And the value wasn't great if you sold it forward because you hadn't developed the growth period yet. But that brings about a lot of very dangerous elements to the whole thing, because what happens is if a developer is looking at selling, they will try and optimize the rental, and they try and push the rents. And one of the things we've been able to achieve over the years is very strong relation with the banks, because we don't go and optimize or push the rents ahead of market. We're quite conservative. In fact, one of the banks mentioned to me a little while ago that they like our positioning because we come in at a bit of a discount to where the rest of the developers go. And the great thing that does is it's almost like managing risk, because we don't have exposure to rentals which may go above market and then have to be reverted downwards and so on. So I think it comes back to the principle of whether you're dealing as a principal or as just an entrepreneurial entity. And the long-term view allows you to structure your deal in a manner that's more sustainable.
I think sustainability is key.
And the banks like that, don't they?
Yeah, certainly do.